Everyone, and thank you for joining us at the 9th Annual Startup Boston Week. The mission of this conference is simple, it's to bring people together across the entire startup community, every industry, department, and funding stage. Startup Boston exists to connect, educate, and celebrate this ecosystem while serving as a trusted, unbiased guide to the best resources that can help you start and scale your startup. My name is Linda Brown, and I'll be your host for today. I'm a serial startup person. I've been part of 3 successful exits and 4 other M&A events that were of various pleasantness. Before we kick things off, I did want to again thank Suffolk University for providing the space. I was just talking with a fellow Rhode Islander, and our startup week is spread out all over the state. So this really is a wonderful opportunity to have the entire event in one space, and that's possible because of Suffolk University. That's about all I have to say. So I'm going to turn it over to Anushka, and she will moderate our panel. Thank you.
Thank you. Hi, everyone. My name is Anushka. Welcome. I hope you all had a great lunch and are excited to get started. Today's panel is Slice It Right, Dividing Startup Equity Without the Drama. I would argue probably the most important panel of the entire week, having the most long-lasting repercussions. So my recommendation to all of you, please, we have a 15-minute Q&A at the end. Ask all the questions that you might have. Small, big, does not matter. There's no question that's too dumb or too far off. We have some great, knowledgeable panelists here. Use their expertise while you have them. And another small recommendation, if you have a paper and pen with you, please take handwritten notes, because you might forget some of this stuff, and it will come in handy. Now, that being said, I would like our panelists to quickly introduce themselves, because they can do a better introduction than I could ever do of this.
Okay. Hi, everyone. I'm Annie Garofalo. I specialize in co-founder relationships. So what I do, my practice kind of provides premarital counseling to co-founders, not married co-founders, just every kind of co-founder. It's a very intense relationship. And so I apply couples therapy principles to people starting companies together. A bit about my background. So I started my first company almost 10 years ago with one of my closest childhood friends. We moved to Guatemala. I don't speak Spanish. There were a lot of hurdles that we had to overcome. And surprisingly, the hardest one was our relationship, which is what got me focused in the space. I went to Stanford to study my MBA and a master's in sociology, specifically looking at how to apply these couples therapy principles and communication frameworks to this really intense relationship in the entrepreneurial ecosystem. So I've now been doing that for about 5 years, and I'm excited to share a bit about what the research says and ideal ways to have some of these harder conversations as you're establishing your company or thinking about establishing a company.
I love that. Couples counseling for startups. So, hi, my name is Jason Freeman. I've been an entrepreneur now for over 15 years. I've been lucky enough to work with some great co-founding teams where we had to deal with a lot of these challenges. My first 3 startups went to exit, all 3 strategic. And then I'm in for another 4th one right now, which we're making progress rapidly, and I have a really great co-founder, again, dealing with lots of these challenges. I also encounter these problems as a mentor and advisor, formal advisor. So I'm a Techstars All-Star mentor, but I'm also a mentor for the Harvard iLab and for Startup Boston, and an advisor for some just great companies. But everybody's dealing with this stuff, so excited to chat about it today.
All right. Thank you so much. It's amazing to have you guys here. I'm going to start with probably the burning question and the most important questions right off the bat, which is, what are some of the best practices for ensuring an equitable distribution of ownership amongst co-founders? Jason, can you start?
Oh, sure. Yeah, I mean, I think a best practice is starting off with knowing yourself, knowing what you're bringing to the table. So I think a little self-reflection is, not a little, a lot of self-reflection is really important. You're going to approach a huge problem. So I had an investor give me this criteria around an investable company. So the first thing they said was, is the problem big enough, right? If it's a huge problem, there's potentially a huge market to go there. Is the solution somewhat feasible? Yeah, okay, makes sense. They know the solution is going to change. But then he said something that I don't think I'll ever forget is, does the founding team have an unfair advantage? And so what makes you as a contributing founding team member to say, yes, I have this unfair advantage, that brings a ton of value to this table. How am I going to, how are we going to identify that value, respect that value I'm going to bring to the table, and make sure that there's, that it's recognized through an equity contribution, for let's say. So I'd say the first best practice is know yourself, and then also be a good study of the people you're going to be working with, because it's really important.
Yeah. And do
Yeah.
you want to take that?
Yeah. Just to add to that, I would say a best practice I recommend to mentees is not to jump straight into the equity conversation, but to creatively test each other out as co-founders, and also test out the viability of your company. If the first conversation you have is about equity splits, you're going in without much information. You don't know how long the company has legs for. You don't probably have product market fit. You maybe haven't worked with this co-founder before. That's a lot of information to collect. And you don't need to incorporate a company in order to gather more information about the decision you're making and moving forward. So I would say, in lieu of having the conversation start with, are we 50-50? Instead, figure out a way to have a trial period where you're clear on, if you don't end up working together, what is your ownership, like who owns the company and who kind of steps away, and having all these conversations up front with these shorter chapters. Like right off the bat, your chapter is not going to be a 7 to 10 year exit. You need to break that down into much smaller chunks of time. And that is especially important for students. So I often work with students, and being able to use graduation as a milestone, and you probably don't want any equity to vest before that. So we can get into the logistics of it, but I'd say my biggest best practice is don't jump into this as the first conversation. It should be one of the final conversations of that initial chapter.
All right. So that being said about equity distribution, can you guys talk a little bit about what is the real world impact of an equity distribution, like co-founders, whether it comes to decision making or like navigating roles and responsibilities? How does an equity distribution affect that? And I'll have Annie go first.
Well, I have kind of a hot take. I think their equity distribution is important, but it should be a representation of your roles and responsibility and governance structure, and you should define that first, and then have the equity distribution follow that. And that the way that you define your governance structure and roles and responsibilities should happen over conversations, over time. And how, the ownership structure is just like a numbers way of bringing those decisions to life, and they can also be tweaked. Like, I think one of the biggest misconceptions I see is that if you kind of create like a pool at the beginning, or how you do your initial equity distribution, there's ways to delineate a portion of your shares, but allow other shares so that you can more flexibly change your ownership structure in the future without having to add more shares. So these, again, are getting into the logistics of it. There's like a more logistical panel with lawyers, I believe, later this afternoon. But my point is, one, start with those conversations of governance structure, roles and responsibilities, and create a path to make sure that like you and your co-founders are able to scale with the company, that you have the right skill sets to do that, that you're able to be really good managers before you make those decisions. And if you've already made that equity distribution decision and realize that maybe one of you isn't the right person to scale that company, that there are ways to rearrange as well, as long as you put that structure in place up front.
Yeah.
Well said. I think that word distribution is really interesting, because if you're building a company that scales, the equity is really not distributed to you yet. So so if you're going to get investments, you're hopefully going to get legal counsel and advice around that this equity should be vesting over time, even for those, especially for those co-founders who, I had another investor tell me, Jason, you don't realize the power you have in your feet. If you walked away, almost the entire value of this company disappears overnight. And he's like, we had a very, very close relationship at that time. He was my lead investor, but we would go to lunch weekly together. So he was really investing in me, and he told me the truth about that in terms of a lot of entrepreneurs don't realize how much power they have in their feet. So my point is that if you're building this company to scale, if you're building it to do something really great, there is what's going to be called a vesting schedule and how you're getting this equity compensation. And there's lots of ways to think about a vesting schedule, and a lot of the ways that I think about it are probably contrarian to a lot of advice or maybe direction you might get. So I don't know if it would be helpful to talk about some of those things.
Yes. Yes.
So maybe a little bit of a contrarian view, like I'm founding my 4th company right now. My co-founder and I made a decision that we were going to have vesting on our what's called, so another term maybe to look up is founder stock. But we were going to have vesting on that. But we were getting counsel around well, would you build in another Google term, a cliff into that vesting? And basically what a cliff is if your stock is getting allocated to you over a period of time, let's say 4 years, right? If it's getting allocated monthly, then that monthly allocation, it's adding up, but you can't actually have access to it until at least a year passes, right? So that's called a cliff. And we decided not to actually have a cliff in our vesting schedule. And the reason I gave to our legal counsel is we've done our founder dating for 6 months now. We've been talking it through deeply for 6 months now before we're even trying to bring something to market. And I know at this point that the only reason my co-founder is leaving if it's some major life event. So I know I'm going to be calling you at that point anyway, saying let's get him his vested stock anyways. That's the only reason he's walking away from this at this point. So why am I going to build that in? Let's start off from a trust but verify. The stock is vesting, right? But we don't need a 1-year cliff. If for some reason a life happens, we're both fathers of young children. Life happens, right? And so that's one example of I wouldn't call it a distribution. This is a very complex thought process, and a lot of it has to go into a lot of trust in your co-founder. I don't want to I can think of another example too. Is that okay?
Yeah.
Or do you want me to save it?
Let's save it for another.
Okay.
Because I just wanted to. So you actually answered my second next question, which was around vesting schedules, and how to use them effectively in an early stage relationship. So I just wanted to hear a different point of view, Annie. If you have seen vesting schedules, how different founders have used them. Maybe some situations where it might not have gone right.
Yeah. And so for those of you who are new to vesting schedules, I looked up what is the most regular of the schedules, and the most common is a 4-year vesting schedule where it accrues at a certain point with the 1-year cliff. So that's what's typical. I would say that's not necessarily what you should do, but that's just so we can all level set on what's true. And that happens at some point post incorporation or post fundraise. So I'm less, the teams that I typically work with are either already kind of have that not distributed, but that arrangement set up, or they're pre-incorporation or pre-fundraising. So I might take the question in a little bit of a different area, which is how do you have this conversation where you want to be building that trust or be kind of co-founder dating without having these legal documents binding you to some schedule. And one platform that I highly recommend is called Slicing Pie. And the way they dynamically split equity over the course of time is by accruing it based on your hours that you put into the company. So the platform itself will create a slice per person, whether it's co-founder or maybe advisor or early team member, and it will distribute this equity based on things like your market rate or how much cash you've put into the company and things like that. So the platform handles that for you. And then once you incorporate or raise a funding round, that pie freezes and then it becomes enforceable, like you can pay them out or they become like a portion of the capital table once you have investors. So this is just a really creative way to kind of compensate people for their worth, but also say you'll only get paid if this succeeds, which is also a good incentive alignment. And it means that you don't have to pay them out of pocket and that everyone gets paid out when there is a successful outcome or a successful milestone. So again, that's called slicing pie, and the principle there is dynamic equity splits.
All right. Thank you. I just wanted to shift gears a little bit. So we spoke.
Can I talk a little bit more about vesting? Is that okay?
Yeah. Okay.
Do you mind?
No. Please go ahead. We have a few seconds.
Story.
Okay.
Yeah.
Oh, the second story. Yes, exactly.
Okay. Yeah.
Yeah, so the other thing to consider about vesting schedules is not just for the early founding team, like the co-founders, let's call them, but also for your early employees. And so that vesting schedule, it usually tends to be allocated towards around a different type of stock, which is called options. And options are really interesting because they are basically a promise to be able to buy a stock at a very, very low price in the future. So you're pricing an option early, and then hopefully it sells for the stock that it's associated with sells for a lot of money later, and you make up the difference as a founding team member. And so another thing I maybe contrarian view around options that I've come to understand for myself is my first startup was a fairly quick exit. And so I've had that in my mind of my earliest team, do I want to incentivize them around this idea of a quick exit, like potentially, if it can work out. And so that early team not only deals with their cliff, but they might deal with other restrictions on being able to exercise their options. And so one of the things, there's something called a trigger. So if a company sales and let's say the acquirer of that company doesn't want to retain that employee, that early employee, and they decide that they're going to potentially lay them off, well, maybe that employee has what's called a double trigger built into their vesting schedule. So that way they're not left in the cold. They've done all this work, but we just happen to sell the day before their cliff, right? So these are things where you're thinking about questions of fairness, questions of like, how do we want to incentivize towards the type of growth we want? That's when I'm thinking about vesting. And then I tend to have accumulated maybe some contrarian views around this concept.
Yeah.
So
you just took away my next question,
I'm sorry.
which was around strategies that founders can use to allocate and manage equity for early team, advisors, and investors. So you mentioned a great point about early teams, which is the ESOPs, the employee stock option pool. I'll just ask Jason about this. How would you manage equity for early advisors and early investors?
Yeah, I mean, this is a really important question. I can give you an example of I'm kind of dealing with right now. So what happens a lot of times in the early stages, especially if you're going to raise money, is your earliest investors, let's say they're angels, will often be very strategic. And so they kind of are like, is this an advisor? Is this a mentor? Or is this an early investor? They're often like wearing all three hats for you. And like I'm experiencing the really good problem to have right now where like one of our earliest strategic investors, like she is just on fire for our company right now and is doing so much to try to get in front of things. And I'm like, really, should we be compensating as a formal advisor for her in this case? So it's like you're thinking through who's going to accelerate the business and how do you incentivize them for the upside around that. Yeah, it's really interesting. A lot of this has to do with timing too, because options are only valuable if they get priced early enough.
Yeah.
Does that make sense? Does the concept make sense? And so it only is an incentive for them if we can price it early enough in the company's history to make it pay off later when it sells for hopefully $1 bajillion, right? Yeah. So these are important questions. It's like pricing them early for your advisors. It can be a really, like, you would think, well, I don't have the money to like go out and pay for the process of pricing those options out. Maybe a term that's going to be in that later panel is a 409A valuation. That's how you can price an option. Yeah. But you're like, that costs money. But maybe like because you've priced your options so early, you can incentivize these like incredible advisors to come onto your advisory board because it's really cheap.
Yeah.
So did that answer?
It did. I just wanted to, for anybody who doesn't know how options work and how stock and all works, why it's important to price it early and get stock at a lower price is because when you assign options to somebody, they don't actually own the stock. It's just like an assignment on paper. And let's say if you bought options when the stock price was like 1 cent, right? And you bought 10 options. Let's say 2 years later, the company is selling for $1 billion and one stock is worth $100. For you to get that difference and that equity, you'll actually have to pay the amount that the price of the option when you actually when it was assigned to you. So if it was assigned at 1 cent, then if you have 10 shares, you'd have to pay 10 cents to get that valuation change. If it was assigned much later on, and let's say the value of the share was $10, you would have to pay 10 into 10, $100 and things like that. So when to actually get the equity assigned to you, to get the stocks assigned to you, you have to pay the amount of whenever you bought those option pools. So that's why getting it early is important because you get it cheaper. And then if you have a larger exit, that's a much bigger gain for you from an investment point of view. I hope I explained that right. If I didn't,
Well, the whole game is basically, can
Yeah.
you attract really great talent early?
Yeah.
And you incentivize them by saying, our stock is really cheap right now, but you see all this great potential in us, of course, right? We're going to rule the world. And so, get in with us early. And we're going to take care of you because we understand this. And I think this gives me maybe a little bit of an advantage as an entrepreneur is I'm thinking about that so early.
Yep.
And I make sure that advisors and employees know I'm thinking about that. I'm trying to make sure I'm looking out for you in that process. So.
Yeah. Annie, do you have any recommendations on early advisors, early team? How do you manage equity distribution?
I was thinking about this example of which happens a fair bit, where there's, let's say, like 2 co-founders. Let's say they meet as students, and one has an offer to kind of join a larger corporation after school, but wants to keep working on the startup, while the other person is working full time on the startup. So I think there's this kind of like co-founder advisory role that opens up at a lot of different milestones, but particularly for students who are graduating and one has a job offer, one wants to do this full time. And I've seen a number of creative ways to, whether it's adjusting your vesting schedule and actually pausing the vesting as a co-founder and starting a different advisory contract similar to what you had mentioned, that can often feel more fair. But I guess I just wanted to name that dynamic that can happen, and using this as that's aligning the right incentives and is also mapped to the hours that someone's putting in, the risk that they're taking, the role that they're playing at the company. So even if they have that co-founder title, but they're only plugging in as an advisor, that kind of schedule and equity arrangement looks different than if they were a full-time co-founder. So I guess that's the only thing I would add to that.
Okay. Let's shift gears a little bit. What are some common mistakes that you see, founders make with their early cap tables?
I didn't jump the gun on this one.
Yes.
Did you want to start?
No, go ahead.
Please go ahead, Jess.
So common mistakes on the cap table. I think a common mistake is to not think about your cap table. And what I mean by that is so much of if you're going to go get investment is about signaling to investors. So I had a friend recently, he's really experienced entrepreneur who's going back to fundraising again. He's like, and he had to have this refreshed in his mind. He's like, I went to a top tier VC and there's like, I have the easy pile and I have the hard pile, right? And so the hard pile is usually cap table driven. Like there's some weird thing that's happened with the co-founders. Somebody's left, but still has a huge share of the company. And so again, why vesting schedules are so helpful. Like it's not because I don't trust you. Yeah. It's because we also have to signal to the world that we're serious about this and that we're in it for the longer game, right? And so not thinking about your cap table, thinking you're entitled to those shares as a distribution so early, it'd be a mistake, right? Not building that into your the way that you're going to see your own contribution, but the people around you holding them to the same accountability and standard. I think this is a tricky one because it can really work too, but having a ton of angels on your cap table early can be really tricky.
Okay.
And if they're strategic, then great, awesome. But if they're not, if it was about the capital you needed at the time, like,
Yeah.
how does that work out? And I'm not saying it can't work. It definitely can work, but it maybe is starting to get into the hard pile.
Yeah. Do you mean like an SPV or like multiple angels, like multiple people on your board and things like that?
No, I meant like multiple angels that have
Okay.
invested in you.
Okay,
Yeah.
got it.
Yeah,
Got
and I mean, like, that's fine. It's just like you start to reach a certain point where they're like, well, where's your priced round? Where's your,
Yeah.
and so it's just a signal. It doesn't mean it's wrong.
Yep.
So I wouldn't say it's a mistake, but it's like, what do you want to be signaling if you are going to go raise outside capital?
Yeah. I will add one thing. A lot of, not all investors do this, but at some point, if people are investors and angels are coming in early on your cap table, they might ask for like board seats and like, voting rights and things like that on board decisions. That can become very complex. I don't know if you have any stories or something to share on that.
I mean, your board, you basically are married to them. Like, you better know who's on your board, because that can cause dramatic issues for you. I've experienced it where I was misaligned with my board, one of the board members, and it was really challenging, incredibly challenging. So yes, that's an issue.
Yes. So scrutinize your board members as hard as you would scrutinize a co-founder?
Yes.
Okay.
Yeah, I mean, you won't be able to vet them as far because you're not going to have a working relationship, but that's like you're not going to get the founder date in the same way.
Yeah.
But I mean, something that can help is, are they continuing to invest? Like, that's a nice litmus test. If they're not investing anymore, should they really be on your board? So.
That's fine. Annie, do you have any
Yeah.
horror stories?
I mean, not horror stories. I think maybe like a misconception. Yeah,
Yeah.
a misconception that I often see, especially in teams where they get really stuck or gridlocked on this equity distribution, is the belief that being equal in equity means that you're kind of operating in a fair way. And that's not, I've seen teams where they're 50-50 equity split, but one co-founder is the one that makes all the decisions and the other one doesn't feel like they're in a fair work environment. And in places where maybe there's a 40-60 split, but the 60% co-founder is all about consensus-driven decision making, and so brings that person in as a 50-50 decision maker. So I guess I just want to emphasize that the work culture in the company is not necessarily like what is shown up on the cap table, and so you really do need to do research on both sides of that. And be self-aware, like your first point, be self-aware about what is the kind of decision-making practice that you want in your company. And yeah, just make sure that that's happening. Because just because you have a 50-50 equity split, or just because you're the minority equity owner, it doesn't mean that you'll be expected to show up in any, like, just don't make assumptions on what that means about your role in the company. And maybe I'd have like one other thought about the kind of what I've seen be challenging is when teams don't have like a social contract. So a lot of lawyers will put together kind of a governance structure document and a lot of like an operating agreement and things like that. And usually those are default because it is expensive to hire lawyers and make those changes. So it makes sense to do a default agreement legally. I would also encourage founders to really look at those and create like almost a handshake social contract where they write down things like, what does happen if one of us leaves? Not just on the equity cap table side of things, but also in terms of how we want to be treating each other. And what does that look like if it's a departure due to a strategic disagreement or it's just no longer a good kind of company fit? What does that look like if there's a life circumstance that you have to leave the company or take a break? Like, how much notice do you need to, do you ideally hope to give? What does the transition plan look like? And just plan for the worst. And a lot of founders don't like to do that. They feel like it's jinxing where they're going. But trust me, if that worst case scenario happens, you have much more likely of a much more likely to succeed and continue having your company than if you don't have those conversations and that happens. That decreases the likelihood of success after that that scenario. So I guess I'll say those.
Well, I just really appreciate what you said, because I know like a lot of the things we're talking about feel maybe technical, but this is really a very human choice right now. And I can give you an example where this really hit me. It was on my first startup. Our lead engineer on that startup, who was by far the most experienced business person on our team as well, he passed away suddenly. And the rest of our founding team is like, oh no, what are we gonna do right now? And we had already sold hundreds of thousands of dollars in pre-sales for our a product that wasn't even on the market yet. And so it was this moment where we're just in shock. And then we realized, because he had done so much of the homework and the legal work to set up in case of a scenario where one of us had, had to exit the company or a life tragedy happens, where we had all of the documentation in place to move forward. And I felt like he was taking care of us even beyond his life. That was a really powerful moment, and one that I try to model now. I'm like, how do I do this? Because we all are human. We will perish from this world, and we hopefully leave behind a legacy of, we made the people in our lives better, not worse. And so that's, when you were saying that social contract, I feel like he was living up to that social contract when he was doing the due diligence of what happens if one of us, and we kept the company just kept going and really going well, and we felt like it was also in service to his memory, but because he had done that incredible pre-work. So
no, even I've had first-hand experience with that, where technically even my current startup, but we were doing a different idea back then. It had come to the point where I was with two of my friends, and it had become so the tension between us had become so high that it was about are we saving the professional relationship or are we saving the friendship? Because both could not survive at the same time. And it was a hard decision, but we decided to save the friendship rather than the professional relationship and have a breakup of founders back then. So definitely, we did not have the conversations. We did not have a social contract, and went through that. Had 2 months of slump where wasn't even sure if the friendship was alive. But having those conversations early, definitely a good idea. I know we don't have an investor on our panel yet, but both of y'all work very closely with investors and have taken investment. So I just wanted to get, according to you, what's the investor perspective, and how do they view early equity distributions? How much are they expecting, and then what are some red flags that they see amongst founders?
The biggest thing that I've heard from investors is maintaining a clean cap table. And I don't know the exact nitty gritty of what that means. I think I've seen some scenarios where maybe there has been a departing co-founder who has left the company but still holds over 10% of the company's equity. And that, I think they call that, what do they call? I don't know what they call that. Something. They call that something like debt equity, maybe. I don't know, but it's something that they will then go back and try and have you go talk to that previous co-founder and try to figure out a way to get them to own minimal shares, or buy back or whatever that looks like, but a rearrangement of the cap table, and that just can take a lot of energy and resources. So that's the extent of my knowledge on cap tables from an investor perspective, I'd say.
yeah, I mean, I don't know if an investor would say it this way, but how I think about it on their behalf is, does this cap table work for us or work against us? Is this money, especially if the even the angels, the strategic angels are following on. Are they like doubling, tripling their investment? You can see the trajectory. They're like, oh, they actually believe in this. Like when you have that feeling like of a strategic angel who comes back and they just tell you they're tripling their investment, you're like, okay, that's a signal. This is happening. And so, of course, investors are human. They're going to feel that too, and they're going to feel the excitement around that. They're like, oh, other people are getting really excited about this. And so, is the cap table working for you? If your cap table has a big contingent of that debt equity, it's kind of not a nice term, but that equity that is not going to work for you right now, that's another signal that maybe moves you towards the difficult pile, not the easy pile.
Yeah, and I think building on what you were saying earlier too about having like a lot of angel investors, just having multiple names on that cap table can be really challenging. One workaround I've seen lately is WeFunder is like an angel investing kind of crowdsourcing platform so that you can take money from a lot of individuals, but it's listed on your cap table as just one, as WeFunder, as just like the one contributor. So that's one way to maintain a clean cap table while also being able to have a lot of people put in smaller check sizes to get you to where you need to be.
All right. So I think one thing we all can agree with, if a company is doing really well, equity cap table is kind of like the problems with equity and cap table don't show up as often, but it becomes a problem, especially if you're doing a down round or if your valuation of the company has gone down from, like, let's say, from where you started or where you assigned certain shares. Do you guys have any recommendations to founders if they're going through that? What should they look out for, or what should they avoid to not get into that situation?
Yeah, I mean, I have experienced that scenario. It's very challenging. You have an opportunity, if it's really challenging, to do what's called a recapitalization, where you're basically saying, we're going to change the whole ownership structure of the company, and those initial investors are going to be shrunken down to a much smaller amount, right? It's challenging. I remember what got me through it is, do you have a mission you care about? Do you have a team that's still dedicated to the mission? Do you still have that kind of unfair advantage as a founder, right? Where you can still make your mark and still go for it. And if new investors or former investors, but maybe not all of them, want to recapitalize because the vision is still there and you're still excited about it, I can speak from personal experience, it is possible. That was the time, though, that I had the challenge with our board member, where the board member was saying, no, I don't feel like we should do that. And I said, well, we need to give the investors a chance to do that. And we're going to sit right next to each other when we're going to give the investors a chance to do that. Yeah. And so I remember, having to pull the phone away from my ear because of all the expletives and yelling that was happening on that, and brought it back and said, well, I see you at that meeting. And he's like, yes, I'll see you there. And so it's hard. And if you have something deep down that you're trying to accomplish, that is what can get you through it. I don't know if that's not a technical answer to your question, but
I don't think there is a technical solution. I mean, when you're going through a down round, it's more about saving the company, saving the relationships than the cap table is like a secondary, right? If the people don't survive, you don't really have a company to worry about a cap table. But yeah.
For questions?
Sure. I do have one more question, but I'm not sure how relevant it is. It's around non-competes and non-solicitations. I know Jason had a story he wanted to share around that. On like mitigation practices with founders and how to use these tools.
Well, again, I just call it being human. So back when like non-competes were a big thing in Massachusetts, our co-founding team made a decision not to include those in our employment agreements. We did have a non-solicitation. We did have protection of our IP, but basically, when you're thinking about slicing it right, really, I would ask the question: how would you want to be treated, right? So then I try to go into each of these things as how would I want to be treated. Of course, I'm not going to steal employees from the company. Of course, I'm not going to steal IP. But I shouldn't sit under a non-compete. That doesn't make sense to me. And then yet I'd have the audacity to go to my first and second employees who I'm like, you've bought into this vision. We're in it together. We're going to hold hands. Oh, but sorry, I'm going to hold you to a different standard than I would hold myself.
Yeah.
So.
Yeah. All right. Yeah. So we're open to questions now. We have some great people running around with mics. Yes. Do we? Yeah.
Hi, my name is Brendan Lewis. I just started working with a startup, and I wanted a question about how I should ask them about equity and payments and all that, since you guys were more founding oriented.
You want to start with that?
Yeah, sure.
Announce to the session after this on the fifth floor is going into a ton of additional detail and specifics. So just letting everybody know that is happening.
Yeah.
Like from the human side, like how to request compensation in an early stage startup.
Yeah.
That's a great question.
Yeah, I think the biggest thing is asking what they already have planned, right? So that is a perfectly legitimate question going into a job interview, especially for an early stage, is like, what is your option plan for early stage employees? And like, you can use some of these terms and maybe look them up before going in, but like, are there triggers if the company sells? Like, these questions are not threatening. Hopefully, if
They
as
shouldn't be.
as a
They
founder, this
shouldn't
would be
be.
like, oh wow, this person's really interested in what they're doing and they've done their homework. So
Yeah.
I would say first off, going in and asking the question is not going to put you on your back foot. Like I would put you on your front foot. Like, oh, they're actually getting what stage we're at and how this compensation is actually going to work. So
Yeah.
that'd be
Yeah. Yeah. And the only thing I would add to that is thinking about compensation for joining that startup as like a package. It's not just, equity, it's not just cash, but it's also like, what's your title? And like, can you negotiate up a good title so that it looks good on your resume? Are you taking responsibility for something you haven't done before and like really learning? So make your position work for you and whatever your longer term goals are. And of course, a piece of that is being incentivized by being compensated for the work that you're doing while you're taking this risk. But in the meantime, because we don't know if that equity will be worth anything, make sure you're also getting the value out of the role and the title that you want now as well.
Yeah.
like I love when a potential employee asks me, "What's the strike price right now?" I'm like, "All right, you're getting it now. Like, I know what I can see what's
Yeah.
going on here."
I'll just add one more thing. Just if you're looking for like market rates and how much generally someone in your role would get, Carta.com/data. They do a lot of this research and they'll put out like for your industry within startups. If it's a series like Series A or pre-seed or seed, what are the employee equity ownerships? Also founder equity ownerships, advisor ownerships. They have a lot of data around this. Just giving you like a baseline and then use their suggestions to work on top of that baseline. Carta.com, CARTA.com/data. All right. Yes.
Yeah, my name is Marie Schwartz. I'm a founder who sold their business last year to a strategic buyer, and I'm thinking of starting a second one.
Congratulations.
And thank you. And the question of options always not bothered me, but I didn't really know how to handle it before. And I also find that sometimes when you hire junior people, not to put anything out against junior people, when you start scaling, they don't have the skills that you need, right? So how do you handle options in a fair way, but that gives you some recourse if if it's not quite the right fit? I mean, I've gotten much better at hiring people, but at the beginning, I was not very good at it. And there were people who I wouldn't have wanted to give options to after a year. You know what I mean? So how do you strike that balance? And how do you protect yourself in case somebody doesn't work out?
Yeah, I mean, a lot of these options agreements have built-in structure around like if you terminate that employment, the options, expire, things like that, where whereas like an advisor, actually I feel like the option agreements, because a lot of advisors are investors, so they built them in so that way it's, it's better for them. Yeah. These employee option plan, agreements tend to be employer friendly more. So just make sure that that's built into the agreement and it's definitely a thing you use because You may lay someone off before their cliff, and that's a hard conversation, but it means they don't get their options.
Yeah, and even framing it as like a trial period or a work sample where you're compensating them with like cash and salary, but that they kind of like unlock these options after a year of high performing or something like that. But I also, it's similar to the trial periods that I recommend with co-founders, like as much information as you can get.
Yeah. I will just add one more thing. There is the option, you can always buy the options back from the employee if they are willing to sell, and negotiate that price and all. One recommendation to everybody here, whether you're a founder or an employee or looking to be an employee, please look up these terms, because one of many a times, especially when I go out to hire, junior people don't know how all these equity things work, and the fact that they have to, especially like even advisors and all, if they're first time advising, you have to go through the 83B election. What does 409 valuation mean and things like that. Just recommendation, look all of those up. I think the 2:30 session on the 5th floor might, the lawyers might be talking a little bit more about this, but be knowledgeable by yourself. Don't just rely on the other person conveying all the knowledge to you. Yeah. Yes.
All right, thank you so much. So my name is Andrew Lee. I'm a co-founder of Subric Data. So this is my third time. So I have questions that, I ever have the partner, also the co-founder. So his wife disagree with a share, with a responsibility. Do you have ever seen this problem before? How do you solve it?
Yeah, I mean, it is when you're going into business with someone, you also know you're going into business with their whole family. And so this is part of founder dating I've just recently gone through. Is we talked a lot about being fathers. We talked a lot about being husbands. We talked a lot about the expectations we have. And then one of the things that one of my first co-founder, he gave me this wisdom that I've taken with me, and I continue to share too with co-founding relationships that I've had since then. Is he said, Jason, sometimes you're going to be sprinting and I'm going to be jogging next to you, right? And sometimes I'm going to be sprinting and you're going to be jogging next to me. And so I need you to promise me right now that we know that we're doing our best at all times, right? But those times might be different for us, where you're just in it right now, and I maybe seem like I'm just doing my work as usual. And there'll be times where I'm just in it right now, and you. So he gave me that perspective, this holistic view of, like, you're in partnership with a human being, just like in a marriage, right? And so you have to be transparent in your communication, but also set expectations. Like, this is going to be a season for me where I am sprinting. I need your support in that. And I know that, you have that season coming up later this next year. So let's talk to our families. Let's try to plan ahead. It's not like rocket science, it's communication, right? And respect.
Yeah.
So did that answer your question?
No, it sounds tricky. One trick I use with clients is just trying to help them reframe it from a like me versus you to an us versus the problem, and saying like, okay, we're right now kind of in this gridlock because we've defaulted to like, it feels like it's me versus you, or feels like it's me versus your wife. And like, what is the actual problem here? Like, is it that we're like, what are we really disagreeing on? And giving some time to like defining that problem space. It doesn't always lead to like a perfect outcome. And sometimes if the conversations get particularly challenging, there can be a break in trust and commitment, which are the two biggest indicators of a healthy relationship. And if it goes into contempt, then that can be really challenging. But I found that the kind of us versus the problem, instead of me versus you, can be a helpful reframing mechanism if there is still that foundation of trust and commitment.
Well, and if you're talking like a problem, so like my co-founder and I will have this conversation. I don't assume it's a done discussion, but we've made a decision that we're not drawing salary right now, even if we're maybe bringing on other employees, right? And so like I regularly ask him and say, are you still good with that? Like, are we still okay? Are you still in a cash position that you still feel comfortable? We both have young children. We both have partnerships that are counting on us, and we're not bringing in any cash right now, even as we're bringing in investment. And so it's like, that's not a necessarily easy question, right? But it's an important one, I think.
Yeah, and it gets to that framing that I was saying earlier about chapters. Like the company happens in chapters, your agreements should happen in chapters, and those should be reevaluated at 3 months, 6 months, every year. But yeah, like if you're starting today and you expect it to be the exact same ownership structure in 10 years, that's just probably not reality. So you might as well have the conversation on a more regular basis.
I will say if the actual conversation is the problem, there's a lot of techniques in conflict resolution on how to have a good and productive conversation. There's also a book on that you can go and look up. But the core of all of that comes into, you need to understand what are the core assumptions or the core expectations that they have of why does your co-founder's wife think that it is unequal, of why, what are her ambitions and what is she expecting. And if you can bring that into the conversation, then you might find an alternative way of addressing those that may not always be a higher equity amount. But yeah, I can send you the book details if you want, which explains it much better than I did. Other questions? Yes.
All right, so we were talking earlier about how there's a hard pile and an easy pile for the investors. So I'm on my second company, and I've gotten a little bit of experience with, say, East Coast versus West Coast when it comes to cap tables. So I'd really love your perspective on the school of thoughts between co-founders should have equal share or co-founders should not have equal share, because I have experienced that people have very strong opinions about this in Silicon Valley and in Boston.
Yeah, I mean, it's a. Can I field it? Is that okay?
Yeah.
It is a super challenging question, of course. And if you and your co-founder have gotten to the point where you believe that's the right split, there are ways to just make it more tenable to the investors. So like, for example, you could build into your agreement that someone has decision-making power. And that alone, in my opinion, should dispel a lot of the stress around a 50-50 split. And then in doing so, it's not just on paper, but it's like true that the person who doesn't have the decision-making power can still disagree and commit. So with my co-founder right now, we did split 50-50. We do have an agreement in place where one of us has decision-making power, and the other one, and we had talked about this multiple times, probably like 4 times. And like we went on walks together and talked it through. But we're like, can we disagree and still commit? And after the end of like, I think the second walk or third walk, we both came to the agreement that yes, the person who has who doesn't have decision-making power will still disagree and commit. Outside of like values and morals and like that stuff, but like business stuff. And so, in my experience, that has dispelled any concern around like that 50-50 from a decision-making standpoint. Now, then there's still the question of, do you have equal contribution? And that's when you got to know yourself and you got to know who you're doing business with. But if you've come to that, then I say that's the investor's problem, and you're going to go find a better one. Like, if they're having an issue with that, then that's their issue.
Yeah. I
I mean, this is case by case. So in this case, both my co-founder and I we both have been entrepreneurs before. We're both coming off of quite a bit of professional success. And so it's one of those things where we just talked deeply about it and felt good about the decision in the end and still feel good about it right now. Now, granted, it's not distributed, right? So there's a vesting schedule. So that also makes you investable, saying if there's a problem, then and one of us has to exit, they're not going to get all their stock, right? And so there's mechanisms to build in that you make this a whole lot safer for an investor to say, yeah, I can buy into that, even though there's 50-50 split.
And statistically, just because I was like kind of entrepreneurially raised on the West Coast, where at least with like Y Combinator, they are like default to that 50-50 split. I did some research before this and found that only 46% of dual founder teams split equally. So that's like less than half. Whereas being out there, it's like you feel like it's everyone. At least I did. And then with like trios, it's only 27% that split equity like equally. So I think from those statistics, it emphasizes that point of it really depends on your team and your partnership, and that the decision you make today isn't necessarily going to be reflective of the ownership structure in 5 years. And so if this is something that you get really stuck on with your potential co-founder or with your potential investor, like that's them showing their true colors in terms of they're very positions oriented instead of interest oriented. And that's like a really big flag, or at least a good consideration to know in advance of going into this partnership with them.
Yeah, because that's not going to be the only thing they're going to argue with you about that feels ticky-tacky, like.
It's a representative.
Yeah, it's representative, yeah.
Hi there. Thanks so much for this. So I think we've talked a lot about kind of how to set everything up well so that you go into something well. And I'm curious about, like, for those of us in the room, hypothetically, who've already set something up and maybe not asked all the questions that you've talked about as best practice, like, what should we be considering if maybe we did go in with equal partnership and it's not terrible yet, but like the flags that you've presented could happen, or like how do we walk things, how do we think about readjusting while managing relationships and all that stuff?
I mean, so much of this is about leverage. So it's like, do you have the right board who can help you? Because I've had that situation before where something's going off the rails, and know that my board member gave me this metaphor. He's like, we have no triangles here. He's like, so like we are all in alignment. It's not going to go like this, right? It's going to be back and forth communication, because you might have a co-founder who goes to the board behind your back, right, and says, the company's not going like how it should, and these things. And then that's when, if you have a good board, they're like, well, then let's bring everybody into a room. Right? So having some leverage and having some backup there. The other thing is speaking to the mission, speaking to traction. If the company is doing important stuff and making progress, that can be both something a little scary, because you might have a former co-founder who's sitting on that equity and it's dead weight to you, right? But you can also maybe speak to their what got them excited about this in the first place, and you can go to them and say, do you want this to die? Because if I can't raise money right now, it's going to die. And if I can't raise money with this dead weight on my cap table, so what do you want? You're at a decision point for yourself right now. You can sit on this and it's not worth nothing, or you can help us and it's potentially worth something, and you get to say you were part of something really important.
Yeah, and if you're like earlier on in that journey where it's just like you're like, I wish we had these conversations, but we didn't. I think it's never too late to have the conversations, and the way that I recommend the framing of it is tie it to like an upcoming milestone, and just say like, hey, like we're gonna need to be like growing really fast for this next fundraise, or we need to be preparing for this as partners, and use that to frame up the conversation around that social contract. Like, here's some topics, and I'm happy to talk with you about the topics that I recommend teams to cover, but like I typically work with Series A teams. So they've already been operating for many years, have like 100+ employees, but they're still having these conversations and like iterating on them. So it's not too late.
I will add one more thing. A lot of these things around equity and at least the things on paper can be changed. They are malleable and there are ways to change it. The only downside is to change it, it requires a lot of lawyer fees. So if you don't like paying lawyers, might set it up early on in a better way. But yeah, you can always go back and have these conversations. Even in early stages, I have had a bunch of teams break up and people come and go. It's the only thing that you need is the courage to have that hard conversation, and hopefully it resolves in a way that you have minimal lawyer fees at the end of it. Yeah.
That's awesome. Thank you. I really want to thank our speakers today. Very insightful.
One last question. One last question. I'll ask. I just before we end this, I wanted both of them, because it has been 1 hour and I don't think we remember everything that was spoken here. If you have one takeaway that you would want everyone to go back with.
I got my takeaway.
Oh, you got your takeaway?
Oh, all right. Okay.
You share yours first, then
Yeah.
we'll add.
Okay.
Well, my takeaways, having had many issues with options and everything else, One is the Slicing Pie app. I think it was a wonderful thing, and I wish we had had that. Making things more human. Thank you. And I'm a big fan of therapy and that third-party view. So I love the thought of bringing somebody in to act as that voice of reason when you have those tension-filled conversations. And then the last thing is self-education, because you do not want to know what my first alternative minimum tax bill was on my stock options from my first startup. It was bad. So you do want to educate yourself if you're getting into that situation, even as an employee.
Yep.
So those are mine.
Yeah.
Amazing.
I mean, that definitely covered mine. That was amazing takeaways. Mine is that it's like equity is more than just like the numbers and the cap table. It should be a reflection of your partnership. And so do the work that and have those have the courage to have those hard conversations to create a structure that works for you.
I like the marriage counseling before you get married idea. I think this
Yeah,
is
premarital.
really powerful that you said at the beginning.
All right. That was it.
Awesome. I'll also say too, for folks early in their career, do not worry about the options. You will get so much valuable experience and exposure to different roles by being in a startup. It will pay for itself. Think about it as a bonus. Yes, maybe this will come to fruition. You will learn so much in the meantime that you should not be worrying about it if you're early in your career and you're anywhere past, like I'd say, the 50th employee. Just go and have fun with it. All right. Closing script. We know that you probably want to mingle and line up with each of our panelists to ask them more questions, but we do need to reset the room and have people sign in for the next event. So I will eventually forcibly herd you out of the room, but if you could help me with that, that would be greatly appreciated. Don't forget there's a community bulletin board on the first floor where people are exchanging ideas and opportunities. Also, the headshot stuff is upstairs. That's really fun. And I mentioned the next session is nitty-gritty stuff about all the documents and all the legalese for this kind of stuff. And that's up on the 5th floor happening at 2:30. And that's it. Thank you, everyone. Appreciate your time. Sorry, I wrote all my notes.